The biggest fight in crypto regulation history is happening right now in Washington, and by the time most people realize what's at stake, the outcome may already be decided. Tomorrow, May 14, the U.S. Senate Banking Committee. But behind the scenes, the political war over this bill has exploded into complete chaos. More than 100 amendments have reportedly been filed ahead of the vote, and the banking lobby is now fighting aggressively to stop key provisions from surviving committee markup. According to reports circulating across Capitol Hill, banking groups have already sent more than 8,000 letters to Senate offices demanding lawmakers crack down on stablecoin yield provisions. And now, senators are being forced into what insiders are calling a direct showdown between traditional banking interests and the crypto industry itself. At the center of that resistance is Senator Elizabeth Warren, who has reportedly filed more than 40 amendments against the bill. In a late-night post, Warren openly attacked the legislation, writing, "Around midnight, banking GOP unveiled new crypto legislation. Among other flaws, it will turbocharge the massive conflict of interests posed by Donald Trump and his family's crypto ventures. No bill should move through the banking committee without real ethics guardrails." That statement immediately intensified fears that tomorrow's vote could become one of the most controversial moments in crypto's political history. The story gets even deeper and more chaotic, so ensure you stick around to the end. But before we proceed, if you enjoy macro, crypto, and breaking financial news updates like this, make sure to like the video, subscribe, and turn on post notifications so you never miss another major update as this story develops. Thanks, and let's dive right in. What makes this moment so important is that the Clarity Act is no longer just a crypto bill. It's becoming a referendum on who controls the future of money in the United States. One of the most controversial battles now revolves around stablecoin yield, specifically, whether crypto companies should be allowed to offer users returns that look similar to bank interest. Traditional banks are pushing hard to restrict that ability, arguing that stablecoin issuers could effectively become shadow banks competing directly with the financial system. Crypto supporters, meanwhile, argue that this is exactly why the technology matters. It allows people to move, store, and earn on money without relying entirely on legacy banking institutions. Senators Jack Reed and Tina Smith have also reportedly filed an amendment that would incorporate bank-requested restrictions into the legislation. The proposal would limit crypto firms from offering rewards considered substantially similar to traditional deposit interest. According to reports from Capitol Hill insiders, this amendment is being viewed as a direct test of whether lawmakers side with the banking industry or the crypto industry. For Republicans who have positioned themselves as pro-crypto while also maintaining strong relationships with banks, the vote could become politically difficult very quickly. And the pressure campaign appears massive. Banking trade organizations are reportedly threatening to escalate their fight all the way to the Senate floor if they lose this week's markup battle. One banking leader reportedly stated, "Thursday is Thursday, and there are 24 members who will opine, and we still have 76 members left to go before this thing is finished." Another reportedly criticized the crypto industry's public lobbying strategy, saying, "We don't debate this on X, we're very professional." That comment alone reveals just how serious and personal this battle has become behind closed doors in Washington. At the same time, Democrats themselves appear increasingly divided. In a surprising development, Senate Minority Leader Chuck Schumer reportedly told Democratic members he wants a good crypto bill to pass, though he also emphasized that ethics negotiations still need more work before the markup proceeds smoothly. That's important because it signals that opposition to the Clarity Act is not necessarily about killing crypto entirely. Instead, the fight is increasingly shifting toward control, oversight, political leverage, and who ultimately benefits from the next financial system being built around digital assets. While Wall Street fights to preserve its dominance, millions of ordinary Americans are being crushed by inflation, rising costs, currency debasement, and an economy that increasingly feels designed to benefit asset holders at the expense of everyone else. And according to Jack Mallers, that divide has now become impossible to ignore.
The tale of two wolves. So Main Street versus Wall Street. I want you guys to look at this. In the blue line is Wall Street, S&P 500. In the red line in this visual is Main Street, consumer sentiment. And it's moving in opposite directions. And the tweet writes, "The gap between Wall Street and Main Street has never been wider. U.S. consumer sentiment fell 1.6 points in May to 48.2, which is an all-time low. Guys, yes, all-time low, as in below the 2008 financial crisis, below the 1980s recession. I'm telling you, all-time low consumer sentiment on Main Street. All-time low for consumer sentiment for the everyday person. The brick by brick, the salt of the earth, just the normal people. They want to have family. They want to own a home. They want a good life. Never been worse. Now, at the same time, the S&P 500 is trading at an all-time high of 7,400. Wall Street at all-time highs. Main Street is in a crisis. This is going to be the theme of this show. So here are my two wolves, okay? On one side, you have this boom. So the S&P Q1 EPS is up 27% year over year. That's EPS, earnings per share. That is absolutely outrageous. EPS revisions keep going up. So companies are revising their EPS, their future forward looking. They keep revising them up. We'll get into that graph in a second. Forward looking token consumption of AI is up 24x over the next 4 years. That is absolutely absurd. Tech over SPY ratio. So how dominant is technology in the overall market right now? It has surpassed the dot-com highs of the late 90s and early 2000s, and the S&P 500 is at an all-time high. So on one side, again, you have an absolute boom. Productivity, growth, real cash flow, and again, is this another dot-com bubble? Maybe. So I have no idea if this is another dot-com boom, but it's just AI instead of dot-com. However, what I will say is it's not so clear to me. I think people are drawing those conclusions just to benefit their peace of mind because the government was running a 2% surplus back then. We're now at a 6% deficit. The reason that that's such a stark difference is because there's so much more liquidity being plowed into the economy. Government spending is the private sector's revenue. It's the private sector's profit. Keep that in mind. They're pouring gasoline onto the fire, you see? And so it's the combination of there's actually an opportunity to deliver deflationary forces, to deliver technology innovation, to grow margins, to grow profit. You're seeing companies replace humans with AI. They're growing their margins. They're growing their gross profit. They're revising their EPS on a go-forward basis. And they're getting all the tailwinds and support from further and further and further government spending, further and further and further debasing of the currency. Now, the other side, the other wolf, is that gas is approaching $5 a gallon. It's going higher. The 30-year yield just crossed 5%. Supply chains are completely collapsing. Consumer sentiment in Main Street is at an all-time low, and the Strait of Hormuz remains closed with no clear path of how it will open. How crazy are these two wolves? Now, this chart says the same thing. It expresses the same idea of this Wall Street versus Main Street. This is the people bear the brunt and the tax ultimately because they are the currency holders and their wealth is being debased, and the asset holders, the upper 10% of the economy, the people that own all the stocks, that own the real estate, that own the assets that are being inflated. So this tweet, if you work for a living, your share of GDP has never been lower. If you hoard capital for a living, your share of GDP has never been higher. And the visual shows stock market as a share of GDP, all-time highs, total wages as a share of GDP, all-time lows. And this will be a consistent underpinning of today's show. This is what fiat does. It erodes the middle class, it taxes the bottom, and benefits the top. It's not necessarily Jeff Bezos' fault that he's getting wealthier while on his yacht with his new wife. It's because he owns a lot of assets. He owns a lot of Amazon. He owns a lot of real estate. He owns a lot of stuff. And you're seeing inflation in everything except the currency. Bitcoin is inflating. Amazon stock is inflating. Eggs are inflating. Real estate is inflating. Oil is inflating. Energy is inflating. It's all inflating in dollar terms because the dollar is being devalued. And so if you can afford assets, you are benefiting from what this tweet describes as hoarding capital, just owning stuff. Now, if you cannot own things, if you are part of the population, if you are part of the population that cannot quite get a house yet, that doesn't have a excess cash flow to invest in stocks yet, that can't find a way to buy some Bitcoin, well, you're getting crushed because every single paycheck, total wages as a share of GDP, is getting you less and less and less of a slice. Because all of the US dollars, the cuck bucks that you're getting bi-weekly as a form of a paycheck, every time that hits your account and payroll is processed and you got paid, it's getting you less stuff. You're getting further away from ever owning a home, further away from ever being able to stack sats.
When crypto crashes, people panic. When the stock market dips, people sell. But gold? Gold has held value for 5,000 years, and it's not slowing down. Most people don't know you can hold physical gold and silver inside a tax-advantaged IRA. With iTrustCapital, you can. Buy and sell gold and silver 24/7. No dealer markups, no waiting on phone calls, no outdated processes. Just a few clicks, same as buying Bitcoin. And here's what makes it powerful. Pair gold with crypto in the same account. One hedge, one growth play, one platform. Your metals are held with institutional-grade custody and full tax reporting. Gains inside a Roth IRA? Tax-free. Real U.S. customer support. $100 bonus when you fund through the link below. Markets change. Gold doesn't care. The deeper point Mallers is making is that America is now operating under two completely different realities at the same time. On one side, Wall Street is booming. AI companies are exploding higher. Corporate earnings continue smashing expectations. Liquidity keeps flooding into markets, and asset prices are reaching historic highs. But on the other side, Main Street is quietly collapsing under the weight of inflation, unaffordable housing, rising energy costs, weakening purchasing power, and historically low consumer sentiment. Mallers argues this isn't accidental, it's the direct result of a system where endless government spending and currency debasement inflate assets faster than wages can keep up. And that's where Bitcoin enters the picture.
So the escape valve, where does Bitcoin fit? I found this from Luke really fascinating. So he charted the inverse of the MOVE index, which is the bond volatility index, the VIX, and Bitcoin. And you can see Bitcoin, which is in green, reacted to the sharp reversal of the MOVE and the VIX. And that's really fascinating. Bitcoin seems to be implying that there is very serious liquidity that is protecting markets and protecting volatility from screaming upwards. And Bitcoin seems to be, it's that whole Bitcoin is a liquidity smoke alarm. The smoke alarm's going off. And I've kind of been alluding to this over the last few episodes. Bitcoin at 82,000 with the Strait of Hormuz being closed and volatility, the VIX was hanging out at 30 2-3 weeks ago or whatever that was. And now it's at 15, 17. The smoke alarm's going off. Liquidity cometh. They're running it super, super, super hot. And this is a visual expression of that in a chart. And then the other here from Frank, he posts really good Bitcoin charts. This is the choppiness index. And really what this is saying is you can think of the Bitcoin market like a coiled spring. Like it chops around and it gets range inbound. And whenever the choppiness index drops means that the spring is uncoiled and it's ready for absolute rip-your-face liftoff. Then Bitcoin goes on a new face-ripping price discovery trend. And it looks like there's a chance for that. Again, this is another chart which arrives at the same implication as what we've been saying and what Luke is saying, which is liquidity is coming and Bitcoin seems to be smelling it and the choppiness index seems to be falling. And so the chart is highlighting where things look similar when Bitcoin was at 13K and it then went on and exploded to 70K. Similarly, when Bitcoin was at 30K and it went on to go to 126K, now it's at 80K and we're seeing the similar signs. And, you know, what we could have witnessed in the run up to 126K was a bit of a fakish bull market. We were still in QT. Interesting. So no matter how you slice it, now we might get a financial crisis and a serious disaster due to the Strait of Hormuz being closed and the global supply chains being so screwed up because of the conflict in Iran, that might happen and Bitcoin might fall to 60K. Everyone should be prepared for that. Stay humble, stack sats, earn more than you're spending, stay healthy, be with family. Do not add reckless leverage. Do not try and task yourself with predicting the future. It's a pointless job. It's a soulless job. Stay humble, lower your time preference, stack those sats, turn on those DCAs. Either way, you win. But it seems to be that liquidity is coming no matter how you slice it. If we make a pit stop lower and then go higher, or we just scream higher, it looks like the world is unfolding exactly how us Bitcoiners thought.
Mahler's broader argument ultimately ties everything together. The widening divide between Wall Street and Main Street may not simply be a temporary economic cycle, but the natural outcome of a fiat system built around debt expansion, asset inflation, and constant liquidity injections. Those closest to assets, stocks, real estate, technology, and now increasingly Bitcoin, continue benefiting as the currency itself loses purchasing power over time. Meanwhile, people relying purely on wages find themselves falling further behind, even while markets appear stronger than ever on the surface. That's why the battle over crypto regulation has become so intense. Stablecoins, Bitcoin, and decentralized financial systems don't just represent new technology, they represent an alternative escape valve from a system many believe is no longer working for ordinary people. And while Mallers acknowledges the risks ahead, from supply chain disruptions and geopolitical tensions to the possibility of another financial shock, his core thesis remains unchanged. Liquidity appears inevitable. Whether markets experience another major correction first or continue climbing higher, Bitcoin continues behaving like what he calls a liquidity smoke alarm, reacting to expectations of future monetary expansion before traditional markets fully recognize it. But as always, let me know what you think down below. Do you believe the Clarity Act could fundamentally change crypto in the United States? Are banks fighting this bill because of legitimate concerns, or because they fear competition from stablecoins and decentralized finance? If you enjoyed this video, make sure to like, subscribe, and turn on post notifications so you never miss another major crypto and macro update. Thanks for watching, and I'll see you in the next one.